All right, let's talk about JB Hunt's fourth quarter earnings because this report was a classic case of a major disconnect. You had management on one side telling a story of fantastic execution and growing profits, and then you had the market who heard that story and, well, it reacted by dumping the stock. So we're going to dive in and unpack exactly what happened here. First things first, you have to understand the bigger picture. Ken Hoekster over at Bank of America really nailed it when he said the whole freight industry is at a crossroads. We're talking about a brutal, nearly 4-year-long freight recession. So context is everything. Investors are on the edge of their seats, just desperate for any sign that things are finally turning around. And that means any hint of uncertainty gets absolutely punished. And that really brings us to the core puzzle of this quarter. On one hand, the company's story is all about solid execution, smart cost cutting, and some pretty impressive profit growth. But then, on the other hand, you have the market's instant reaction. The stock gets hammered, down almost 5% after hours. So what gives? What did Wall Street see that the company's story seemed to miss? Well, it all starts with the headline numbers. And really, it was a mixed bag that tells the whole story. You had a beat, you had a miss, and then you had that drop. Let's break each of those down. Okay, so first, the good news. This is what the bulls were hanging their hats on. JB Hunt delivered GAAP earnings per share of $1.90. Now, Wall Street was expecting $1.81, so that's a solid beat. On the bottom line, on profitability, they absolutely delivered. But, and this is the big but, revenue came in at $3.10 billion. That was about $20 million shy of what analysts were looking for. Now, you might think, 20 million, that's not a huge miss, but in a market this hungry for any sign of a demand recovery, any weakness on the top line is a massive red flag. And that leads us to the market's final verdict. Investors basically ignored the earnings beat, honed right in on that revenue weakness, and sent the stock down 4.8%. This tells you everything you need to know. Right now, the market cares way more about future growth and demand than it does about past efficiency gains. So, how do we square this circle? An operational win, but a revenue miss. Let's dig a little deeper now into the details to really understand the source of this great disconnect. This table really lays it all out. It shows just how uneven the performance was. Take a look at intermodal. That's their biggest business, moving stuff by rail and truck. Revenue was down 3%, but operating income shot up 16%. That's a huge win for efficiency. But then you pivot over to their final mile business, the one that delivers to your door. Revenue there dropped 10% and operating income just plummeted by 43%. It's like 5 different companies living under one roof. So if you're a bull on this stock, here's the story you were telling. You're pointing to management's execution. They're talking about hitting over $100 million in cost savings. Their big initiative to structurally lower our costs is actually working. They had a record year for safety, and you're definitely highlighting that 16% jump in intermodal profit and a 15% volume gain in truckload as proof that this team knows how to run a tight ship. Of course, the bears have a powerful counter-argument, and it all comes back to that weak top line. Total revenue actually shrank. That final mile segment, as we saw, was a train wreck. And in their brokerage business, ICS, look at that gross margin. It got absolutely crushed, squeezed from over 17% all the way down to 12.4%. That just screams that they have no pricing power right now. And you have to remember the context here. This is so important for understanding that sharp drop. JB Hunt's stock wasn't just limping into this earnings report. It was on an absolute tear, up almost 50% in the 3 months leading up to it. With a run-up like that, the stock was priced for perfection. Good was never going to be good enough. The market needed great, and a revenue miss, no matter how tiny, felt like a huge letdown. Okay, so that's the story of the last quarter. Now, what about the future? Let's switch gears and try to read the tea leaves from what management said on their conference call. The CEO, Shelley Simpson, used a very specific and really interesting word to describe the market. She said it feels fragile. Now, fragile might make you think weak, but that's not quite what she meant. Think of it more like a tightly wound spring. She explained that so many trucking carriers have gone out of business that there's no slack left in the system. So even a tiny little uptick in demand could cause huge, volatile swings. It's a market on a knife's edge. Digging into the Q&A part of the call, we got a few more breadcrumbs. They gave some standard guidance on their tax rate and capital spending. But the interesting part was them noting that their customers still think this recent market tightness is just a seasonal blip, not the real deal yet. And management's response to that was crystal clear. They're going on offense to take market share no matter what. In their words, they are not standing by, waiting for circumstances to improve. So let's put this all together. What does it all mean for the stock and for the next quarter?
It's time for our final outlook and our rating. Let's make the call.
Okay, here's our take, broken down into 3 parts. First, our prediction. That top-line pressure isn't just going to disappear in the first quarter. There's still too much macro uncertainty. The good news is their cost discipline should help protect their profit margins. Second, what about the stock price? We expect the stock to be pretty much stuck in the range. It's a show-me story now. The stock probably won't make a big move until we see clear, sustained proof that freight rates are recovering. And all that leads to our final rating, market perform. The company's amazing execution is already baked into the stock price after that huge run-up, and that's now balanced out by some very real headwinds on the revenue side.
And that brings us to our last bit, the outrageous but plausible trade idea. Look, the stock's valuation is basically pricing in a big cyclical recovery. But what if that recovery gets delayed? If freight rates don't start moving up in a real way by the second quarter, that valuation starts to look pretty stretched. So the play here is to use options, specifically buying some puts dated for the middle of the year to bet on a valuation reset if that fragile market snaps the wrong way.
And as always, please remember this is not financial advice.